You want to lose your money? Well, then listen to Millionaires. Hi, and welcome back to Money Not Math conversation. It is January 12th, 2024. Hope everyone's doing well. It's a Friday. So I know many of you, it's your favorite day of the week. With that in mind, I appreciate you coming back, and I hope you enjoy this Money Not Math conversation. Like I said, if you want to lose your money, listen to Millionaires, along with anybody else who attempts to forecast the investment future. Because I truly believe, and most people that you read will tell you the same thing if they're not trying to sell you something. Anyone who tries to tell you they can predict the future or tries to predict the future is either lying to you or trying to sell something or lying to themselves. We can't predict the future. We don't know. But what we do know, at some point in the future, the market's going to go up. At some point in the future, the market's going to go down. When it's going to happen, we have no idea. And the worst part about reacting to the news is anything that you hear in the news has already been priced into the market, because investors are on top of it a lot more than we are when it comes to just listening to the news. So unless you have insider information, I would strongly suggest you don't make investment decisions about the future based on something you recently heard about the past. All right. So with that, let's jump into the article I'm reviewing today. It is from Morningstar.com, titled "Want to Lose Your Money? Listen to Millionaires." Like I said. So jumping in, it is written by John Rep. I don't know how to say his last name. I'll share the article. You can try to say his last name yourself. So first and foremost, a failed prediction. In November 2022, CNBC asked 761 people who owned at least $1 million in investment assets how stocks would perform during the next year. 56% of them responded that U.S. equities would lose at least 10%. Over the previous half century, stocks had declined by that much only 6 times. So over 50 years, stocks have only gone down by at least 10% 6 times. But yet, 56% of these respondents in 2002 estimated it would go down by more than 10%. So either most of the survey's participants were unusually insightful, able to predict an event with a 12% probability before it occurred, or they were just blithering idiots, says John, not me. My mind, they're just emotionally attached to something that they can't control. But hey, he calls them blithering idiots, and that's okay too. So, about that. What's more, the last time that the poll's respondents were so bearish was 2008, which gives them the millionaires a perfect record. Whenever they heartily dislike stocks, U.S. equities promptly gained 26%. So here's problem number 1, recency bias. Admittedly, the survey was unscientific. How CNBC selected its 761 participants from among the several million possibilities is unclear, but given that the questions were administered online, the result is unlikely to pass academic muster. But hey, today's world, who cares? You see news anchors and celebrities quote tweets as their formal reasoning for information, even though when I was in school, we had to have 2 forms of legitimate information to make an argument. But now, hey, all you got to do is find a tweet that agrees with you, and that's good enough. Anyways, I digress. Besides, most people realize they cannot predict equity returns. Most people. Unfortunately, there's a lot of people out there claiming they can, and a lot of people fall for it. But I'll continue. Ask the question, and they may respond. However, that doesn't mean that they truly believe their answers. Nevertheless, the exercise was revealing. As with all endeavors, investment predictions are strongly affected by recency bias. After a well-publicized plane crash, airline travelers become warier, with their fears gradually dissipating along with the memory of the accident. Consumers are fonder of large SUVs when gas prices are depressed than they are when they're spiking. And when asked about the stock market's prospects, retail investors are gloomiest after bear markets. So after the market's already gone down, people are gloomy about the future. But after the market's already gone up, people are excited about the future, which is exact opposite about when it comes to how things price out and level out over long term. So try to ignore your emotions, stick to logic is basically what he's saying. Avoid recency bias. Number 2, group think. This is the worst in most situations because people don't like to stick out like Rudolph or a sore thumb. Rather than thinking independently, we go with the group because we just assume if everyone else is saying it, well, it must be right. So this is what he says. For the most part, professionals avoid such errors. Almost all attended business schools where they were instructed to avoid recency bias. Also, given the difficulty of making such forecasts, discretion quickly becomes the better part of valor. Their predictions are therefore much steadier than the millionaires' outlooks. Entering 2023, the median projection among 20 Wall Street firms was that the total return for the S&P 500 would be 4.5%. Slightly more conservative than usual. but much above what retail investors guessed. Where professionals run into trouble is with economic forecasts. They are also expected to provide those. And with that task, they do not duck the challenge. When asked in October 2022 about the following year's real gross domestic product growth, Wall Street strategists gave a median answer of a puny 0.2%. Only 11 of the 78 respondents predicted a growth rate that equaled or exceeded the 50-year annualized average of 2.6%, which, in fact, is pretty much what 2023 will record. Consequently, those who use the economic predictions to guide their investments almost certainly suffered for that decision. Typically, the arrival of a recession is accompanied by bond market strength and stock market weakness, albeit with relatively good showings from recession-resistant equities, consumer staples, healthcare, and utilities. In 2023, the opposite occurred. Long bonds struggled to break even, while equities soared. Conspicuously absent from the stock market rally, however, were businesses from those defensive sectors. So, again, another really important reminder that the history does not predict the future. So even though we can make long-term financial plans based on historical principles and long-term goals, we cannot and should not predict the future based on what's happened in the past. Because just like in 2023, what has usually happened did not happen. All right, so back to the article. To some extent, the economists' fears were justified. An inverted yield curve caused by rising short-term interest rates, as was the case entering 2023, usually presages a recession. But professional economists are paid to anticipate exceptions. That so few did owes to the same reason that they missed 2021's inflationary spike. Collectively, they had their eyes on what others were saying. Their analysis were not entirely independent because of groupthink. Problem number 3, wishful thinking. A longstanding joke of my former boss, this is John, the guy who wrote the article, not my former boss, Don Phillips, is that portfolio managers inevitably comment that the previous year was dominated by a single simple trend. You will now hear that making money in 2023 merely required owning the Magnificent Seven, which was Alphabet, known as Google, Amazon.com, Apple, Meta Platforms, formerly known as Facebook, Microsoft, Nvidia, and Tesla. Whereas profiting in 2022 meant avoiding both stocks and bonds because the Federal Reserve was stifling each marketplace by increasing interest rates. Buying growth stocks sufficed in 2021, and so forth. Thus, Bank of America's investment strategists currently claim that 2024 will be a stock picker's paradise. Stock picker's paradise. Meanwhile, BlackRock's chief investment officer of Global Fundamental Equities, the company's active management group, says that 2024 is shaping up to be a bonanza for stock pickers. And Leon Cooperman states that we are entering a stock pickers market. Toronto's Dennis Mitchell claims the same for the Canadian marketplace. So you'll notice that they're paid to speculate on the future, and they're also paid to write things that will sell ads, so you will click on their websites. They don't actually have any idea. They're just saying, hey, it could be great to pick stocks. But I also want to back up for a second. This is really important, and I'll talk about it more in a future Money Not Math conversation, but the Magnificent Seven in the last 12 months absolutely destroyed the S&P 500. I mean, these 7 companies were way up, way higher than anything else. But what they don't tell you is those 7 companies in 2022 were way down from the S&P 500 and the total market as a whole. And I just saw something yesterday. Don't quote me exactly on these numbers, but based on memory, if you would have bought the Magnificent Seven, let's say with $100,000 on January 1st, 2022, on December 31st, 2023, the value of the Magnificent Seven of your holdings would have been almost identical as if you would have put that $100,000 into the S&P 500, because 2022, you'd have been less down, or the Magnificent Seven was more down. And then 2023, even though it was more up, it had a lot more recovery to do. So again, I don't have the exact numbers in front of me, but I just saw that yesterday, and it was a very credible source, dimensional.com. So you can do the more research if you want, or set up a time to call and chat with me, and we'll look through the numbers together. So getting back to the article. No doubt there is actual analysis intermixed with wishful thinking, but don't overlook the powerful influence of the latter. It is for that reason that I routinely discount forecasts of economic booms from growth stock managers and economic busts from bond fund leaders. Case in point, Bill Gross' downbeat prognosis of slow growth new normal that would allegedly depress equity returns made just as stocks entered a huge bull market. So what do you know? You have experts predicting a bear market, and the next day the market goes up, right? It happens all the time. So along with complaints about overpriced stock markets from those who run value funds, in the words of the philosopher Paul Simon, a man hears what he wants to hear. Why bother? It is at this point where I might be expected to wag my electronic finger and counsel investors to ignore forecasts. That I will not do. For one, I can't say that word, would be hypocritical, as I partake. For another, if consumed appropriately, investment predictions can be quite useful. The key is to follow their arguments rather than their advice. Understand the logic behind the prophecy is an excellent way of learning more about both investments and general economy. And I hope I fit in the middle of that with these Money Not Math conversations. I'm often trying to provide value to you based on the information and knowledge I have and what I'm reading and what I'm consuming and what I'm thinking and interacting with other people. But I hope I'm not coming off as like predicting the future, because that's definitely not what I'm trying to do. It's all about trying to increase our knowledge and our logic so we can better perform towards achieving our own personal goals while ignoring the white noise that we often get sold to us. So back to the article, for example, when John studied for his MBA degree, he skipped the macroeconomics requirement. Although he had taken an economics course, such as English majors, no worries. After reading several hundred market forecasts, he had thoroughly learned the material along the way. He had also absorbed the initial lesson of the university's investment class, the difficulty of outguessing efficient markets and how right that was. So this one thing I think is really important to go along with this is why investors might think twice about chasing the biggest stocks. All right. So I know I hear it a lot of people, because the Magnificent Seven did so well last year, they're like, why don't we just invest more in those this year and moving forward? Again, investing in the future based on what happened in the past is a very, very dangerous thing to do, unless you have insider information that I'm not aware of. So I'm going to share my screen. For those of you who are able to watch what I'm doing, great. For those of you who are listening to the podcast, I will do my best to talk through what you're seeing. All right. So this is a video / article written by Dimensional, and they are company that we utilize to build our custom built portfolios, and they do a ton of research and they're very research based. So I very much trust what we're about to see here. But if you'd like to dive into the details, reach out and I'd be happy to either send you the one pager that I have already downloaded. Here it is right here that goes through the same information, or send you this video. So here's what it says. As companies grow into some of the largest firms, the returns that push them there can be impressive, but not long after joining the top 10 biggest by market cap, these stocks, on average, lagged the market. So in other words, they grew more than the market to get there, but once they got to the top, they actually grew less than the market after that. And here's what that looks like. So people often talk about the largest companies trading in the US stock market. In the decade before joining the list of the 10 largest companies, these companies, on average, have beaten the market by an impressive margin. 10 years before, they beat the market by 10%. 5 years before, they beat the market by 19%. 3 years before, they beat the market by 24%. But not long after joining the top 10, those companies on average underperformed the market. 3 years after, they beat the market by 1%. 5 years after, they lost the market by 1%. And 10 years after, they lost the market by 2%. It's a reminder that market beating performance by some of the largest stocks may be in the rearview mirror, and we shouldn't plan for the future using the rearview mirror, right? That's why they always say investing is looking forward, and they make the windshield of our cars a lot bigger than the rearview mirror. So hopefully that was helpful for you. Again, I always appreciate those who take the time to have these Money Not Math conversations. This was a lot of words, kind of a lot of in-depth information, but please reach out if you have questions or would like to have access to any of this material. I can either send you the link to this video. I can send you the one pager that I have downloaded here that talks about historical returns versus future returns for top 10 market cap companies. And of course, I'd always love to sit down and have a conversation with anyone who is passionate about retirement planning and looking for a trusted advisor to help them along the way. So thanks again for your time, and hope you have a great day and enjoy your weekend. Thanks. Bye. Hi, and welcome back to another Money Not Math episode. I appreciate you taking the time to watch or listen to this episode and hope it brings value to you on your retirement planning journey. If it does, please help me provide more value to more people by sharing this episode with a friend and leaving a comment or review. I love to help people have more confidence in their financial future. My mission is to provide the highest quality advice and service to clients possible. Therefore, I limit myself to 100 active clients or less at all times. Please reach out with retirement planning questions or requests for future Money Not Math topics at drew@fivestonefinancial.com. Remember, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation.